Hello, this is Mike Swanson. I run the website WallStreetWindow.com, and the odds are that you're watching this video because you got an email from me telling you that it's up and ready for you. Now, if you're not on my free email list, scroll below this video, look in the comments section, you'll see a link to get on it, completely free, and then every morning before the opening bell, you'll get an email from me, my market commentary, and links to all the most important headlines of the day you need to know about. Now, last weekend, I talked about the public portfolio that I just launched, and we're going to go over that and talk about future changes could be making with it and my thinking about it, because we're in an interesting market, extremely volatile, and it's not really a time in which someone giving you a bunch of stock picks is very helpful, because what's more important now is how you manage your money and your risk and how you navigate a market environment like we're in. And that's what I'm here to help you do now. Let's look at the charts. Let's look at what other people are doing, because this was a tremendous week for the market. On Wednesday, the Federal Reserve raised interest rates, and then the Dow rallied over 900 points. And then on Thursday, the Dow lost 1,000 points. So you had a huge rally. A lot of people came out Wednesday calling for a giant, for that rally to turn into a giant rally that could last for weeks or months. And money flows, and I'll show you how some of the ways I track this, show that there are retail investors piling in on Wednesday's rally, and then everything just dumped Thursday. Friday, the market fell a little bit more to make new lows for the year. But I've been trading the markets now since the 90s, and I've seen this type of market action before. Most of these people trading today on Robinhood and elsewhere only have been trading for a couple of years. They don't really know what they're dealing with. But when you see the market do this, give up all the gains in a day, that's bear market action. That is what is called a wonder rally. And then the loss the next day proves it. We're in a real bear market. And let me explain what I mean by that. People throw phrases around at you. And there's a lot of people that say things that you don't even really know what they're talking about. And that's happening more now than ever before. Clear thinking is needed to navigate these markets, or you're going to end up like a shipwreck. So here's what happened this year with the NASDAQ. Look at the blue line on that chart, the 50-day moving average, and the two lines around 14,500 are the 150 and the 200-day moving averages. These are the most basic and simple technical analysis indicators. I know Robinhood doesn't have it on there when you load it up, but Robinhood is completely useless for trying to navigate this market. Absolutely useless. And people who are trying to do it with Robinhood are essentially navigating this market in the dark. What is important about these moving averages is you can use them to easily identify if you're in a long-term bull market or a bear market, because when you're in a bull market, the market trades above the moving averages and they tend to act as support. When you're a bear market, the opposite happens. In the market, the stocks trade below those 200 and 150-day moving averages, and then they start to act as resistance. So if you look at this chart, what happened this year is we broke below it, then we had a rally back above it where things stalled out. That is the pivot point, and that pivot point has completed with the decline last week, in which we broke, it not only just broke them, but closed below the February and March lows. So the overall trend when it comes to the NASDAQ, the Dow, The S&P 500, the Russell 2000 is down. It's bearish. Now, there are some sectors, a few, that remain in bull markets. And those are sectors you buy on dips, but most people are completely ignoring them. I'm speaking specifically of commodities. Energy stocks are the best performing sector this year. Now, Kathy Wood, I saw do a video update this weekend, and she claimed that energy stocks are going to fall. And don't listen to her because her funds are down 52% year to date just since New Year's. She is down now from where she started in 2020. So all that the giant gain in her, she fascinates people. And despite the losses in her fund, what you see in the chart is the money flows in the fund. She had one of the biggest weekly money flows last week, even though her fund fell much worse than the NASDAQ did. As you can see from this chart of the fund, it's a complete debacle, down 4.4% Friday alone, down 52% year to date. But she got $400 million from small traders piling into her fund. That's not how bear markets end, much less stock market downturns. They tend to end in panic selling. What we saw last week, even though the averages fell, was the individual traders and the small players piling in, trying to guess the bottom, hoping it is the bottom. Desperation buys is the way you should really see them. And I pointed this chart out, this thing before. Orders by Fidelity customers. This is Friday's data. I'm doing the video Sunday, and there are more buy orders than sell orders by roughly 2-to-1 margin. So people are trying to guess the bottom, but most people active in the market now, they don't have the years of experience to understand what is going on. People who just got in 2020 really have no idea what is happening to them. And it's just a tough situation. And it's my hope by doing these videos, a few people will learn. I know most people want to hear, buy these stocks, buy these stocks. They want to hear what they want to hear. But I don't care about that. That's I'm more into making real money, not just gambling and hoping. And so what I believe out of this turmoil will be great opportunities, but those opportunities are not at this moment. You know, this stock market is in a precarious situation, and we're in a downtrend that started in January, and there is no sign that it is over. Now, I mentioned energy stocks made a new high on Friday. They're not in a precarious situation. So let's talk about money management. And as I said, last weekend, I started a public portfolio using tip ranks so we can track it. And it has some analysis features, and we can eventually we'll look and see what other people are doing. And if you want, you can create your own public portfolio and do this too. But I started this Sunday a weekend ago, and I deliberately did it in a way that I would have flexibility to buy more easily or buy something else. So I put a good portion of the portfolio in SGOV as a placeholder. That's just a very short-term bond fund. It's not volatile. It doesn't move up or down hardly at all. And I then bought things that pretty much reflect the way my own IRA is invested. I bought the DBA ETF. It's an agriculture commodities ETF. Here's the chart of it. It's up this year while the NASDAQ is down. Personally, I bought this in 2020, 14% of my money, roughly. IAU is the ETF for the price of gold. I also got about 14% of my money. It was up Friday. And PSQ is a short ETF, shorting the NASDAQ, RDOM is shorting the Russell 2000. So what I basically did is I wanted to show you the percentages, the portfolio details. This portfolio has only been going on for a week. And what I deliberately wanted to do was make it so the portfolio would not move very much one way or the other, no matter what the stock market did. That's why there's a big cash position, there's a short position, and a long position that's roughly 50-50. 50, so I've got longs hedged with a short exposure because I came into last week thinking, okay, we got this Fed meeting that'll probably add volatility to the market, but we're still in a bear market, and I don't want to take, I don't want to really do much, but I wanted to get the portfolio started so we can start a track record. And the action last week is 1 week's of performance, and I want to build week after week of performance. And there you can see, is the stuff I say make sense? Does it work in real life or not? Because if someone just feeds you stock picks constantly or gets on TV saying all these things, you have no idea what the performance is. And this is even applies to the real world, but by tracking this, we can track performance. And that's what I want to do. And you got to use money management to get a good performance in this market. It's just the way it works. And that's why I got a 37% cash position, and the rest of it's pretty much close to balanced out, long, short. And that's where we stand. So that takes us to entering this week in the markets. And frankly, I'm going to repeat what I said last weekend. I don't see a great trade to make here. I just don't. Last week, people were hoping for a big rally, but I didn't think any big rally would be sustainable. That proved to be the correct analysis. However, I also didn't think, last Sunday, I wanted to go crazy shorting things either. So I just 50% long, 50% short. And I feel the same way right now. Frank, and when it comes to shorting, I believe it's too late to short. The time to short it was a month ago. You want to short into rallies, not into declines, because it's very easy. The market could go up again, 500 points or something, the Dow on Monday, and then Tuesday, just give it all up. So that's a difficult environment to do anything. So what I'm basically looking for now is a sign that this decline is really over. And then I would close out those short positions I currently got and buy stuff. Now, if we get a rally that lasted a couple of days, maybe I still wouldn't be interested in shorting. I'm primarily now looking for the end of this decline to do something. That's basically what I'm doing right now. And I don't see a sign of that anywhere. And I'll repeat it, one of the reasons why is that everyone is trying to buy. That's what the Fidelity data shows. People throwing money into ARK is not a sign of that we've capitulated. We need to see the small trader and player give up and sell. They're not doing that yet. And the problem is, it's probably going to take weeks of this for that to happen. Unfortunately, that's just the way it is. And this is a precarious situation. Now, here's the Russell 2000, the new 52-week low. The Russell actually broke down in January when it fell below 210. And frankly, the S&P 500 and the NASDAQ and the Dow look very similar to the way the Russell did the day it closed below 210. What's really driving the market lower is a lot of macro factors. The Federal Reserve lowered rates to 0 in 2020. That stimulated a lot, and people got these stimulus checks, and you combine the two, that helped drive a bubble into the stock market, and then you had bubble gurus like Cathie Wood rise to prominence, and just like what happened in 1999. And her fund is doing exactly what the Janus Fund did in 98, 99, and afterwards. Look it up on Google and read about the Janus Fund. It's a repeat of history. At the same time, we saw a secular bottom in energy and commodities. Secular trends lead to secular bear market bottoms, lead to 10-year bull market rallies or cycles. And that's what we're in with energy and commodities. And that's why I'm so heavily invested in them personally and got that set up, with that agriculture and the gold in that public portfolio. Now, if there's one trend more important than any other driving everything, it's this. This is the TLT ETF tracking the 10-year treasury bond. It's in a bear market, even more of a downtrend, steeper than the NASDAQ, the S&P, and the Dow. In fact, so far this year, the bond market, bear market, is driving the stock market lower, and it has no sign of coming to an end. And this is treasury bonds, but corporate bonds, this is the LQD ETF, are in a steep bear market too. For disclosure, you should know I bought puts on this a year ago and a year before, and the year before that is a hedge in my long positions in my main account, insurance hedge, and I'm grateful I bought that. So if there's an underlying message right now, what should you do? I believe that now is the time not to take big risks in this market. This market volatility is hurting people, and that volatility is only going to continue, if not increase. So the thing to do now is to limit volatility. That can represent, there's different ways you can do that. Now, I set up this portfolio last week, deliberately designed just to start it, so it would not, so to limit the impact of volatility as much as possible. That's why 50% long, 50% short. I've got short ETFs in my main account, just like that, in my IRA too, to try to limit I didn't sell everything, go 100% cash. I took short positions over the past several months. Didn't do it last week. I did it before last week. And, someone, raising some, the key thing to do, if there's different ways to do it, but the key thing to do is to set yourself up one way or the other to be in a position to be able to buy when this is all over. If someone is on margin, they're not going to be in a position to buy when the bottom comes, because they're going to be forced to sell or sell in panic, and then be so beat up mentally that they'll be scared to buy. Being on margin is a recipe for disaster. Being 100% invested is also a recipe where you won't be able to buy when this is over. You want to be able to buy when this is over. You got to have cash reserves. Adding on now is not the time to do it, in my opinion. You want to do it later. So having cash reserves is the key now in this market. And I've got a lot of experience in these markets, and so I got some short ETFs. I'm not recommending you buy them. I would not buy them this week either, because of the situation the market's in. But when I sell them and get out, that's going to become cash that I'll be able to use to buy. So you got to be able to buy one way or the other. Maybe you got a lot of money in CDs or a bank account. You can throw that into a brokerage account and buy. You got to be able to buy somehow when this is over. If you're 100% invested, you're not going to be in a position to buy. You're going to end up, few people will be able to, these people buying now on Robinhood or buying the ARK ETF, they're not going to be in a position to buy later. So that's the key in this market. The volatility is not going away next week. And what you've seen, if you've been losing money this year, year to date, and you don't make any changes, just expect that to continue. So I'm hoping this can help people, take the time to think about what are they doing in their accounts, and do they need to make changes, But this is a much more difficult environment than any, perhaps than any that's come in the lifetime of people that are involved in it, because it's not just the stock market that's declining, but the bond market. In 2008, TLT and bond funds went up in the 2000 to 2002 bear market for the stock market. Bond funds went up. That meant that people that were invested, let's say, with 60% of their money in stocks and 40% in bonds, although their stocks fell, their bonds went up. And now that's not happening. But that strategy of having a big portion of your money in bonds to control risk, to be diversified, has been a great strategy since 1980. It was an awful strategy in the 1970s, and it's showing itself to be an awful strategy again. Why? Because when inflation goes up, as you've been seeing it happen, which is a secular trend, not a temporary thing, bonds go down. So this is going to happen for years, not just a couple months. And that's what's one of the things really beating up people in this market. So personally, I don't think bonds are a good investment. That's gold is an alternative, and gold is less volatile than the stock market, less volatile than bonds. And I think it's going to be great to be holding for the years to come. That's why my public portfolio has an allocation in gold, just as my main account and my IRA do. So consider that. Consider selling bonds to buy gold. Gold could dip, this week or the next couple months. I'm not saying it can't. I'm not guaranteeing it's going to go up. But if it does dip, it's likely to fall less than the stock market and even fall less than the TLT ETF. When the S&P 500 fell over 33% in March 2020, gold pulled back 10% and then soared afterwards. So that and I don't even think gold's got that much downside risk here anyway. When you look at the chart of gold, 1775 is probably the downside risk, and that's just 100 points away. It's no big deal at all. So I'm not really worried about a pullback. It could, it doesn't bother, whatever. I would be worried about a pullback though, if I had 100% of my money in gold with no cash reserves. So having 100% of your money in anything right now, I think, is the move not to make, and cash reserves are the key to have in this market. So that's my message this week. Cash reserves are key, and you got to be in a position to buy in weeks or months from now. And I just don't see nothing great to do this week except sell if it's necessary. If this is the first time you see me on YouTube, hit the subscribe button, and then hit the alert, the bell button next to the subscribe button, and then YouTube will send you an alert when my next video is up. And hit like, because then YouTube will show the video to other people. Then I'll know some people do want to hear this kind of talk. It's very rare that anyone does, honestly. They want to hear the hype. They want to be reassured that the market's going to go higher. they want to be lied to, and people like Kathy Wood deliver the lies. But so I'm like our voice in the wilderness doing these videos. Who wants to be told sell, have cash reserves? Basically nobody. But what I'm trying to do is build a track record of these videos, and some people I know will learn. If 1 out of 100 that hit this YouTube video learn, that's good. I'm thinking about that one person, not the 99 that, what can I do? I can only think about the good I am doing. So this will be an interesting week. We'll see how things shake up, and I'll be talking with you later.